In today's video, I'm going to show you a tried and true method to start generating completely passive income. And that means investing in real estate without any of the nonsense. So let's dive right into it. If you're ready to start investing in real estate, but you're on the fence about how you're going to make it happen, stick around because today you're going to learn why you've got more to gain and far less to lose when you invest passively in real estate. You're going to learn an instant safeguard that passive investing provides that active investing could never provide. You'll learn the kinds of properties that first-time passive investors should keep their eye on, where to find hidden gem properties that will skyrocket your investment potential. You'll learn the one thing you must know before diving into any real estate deal, why some properties are your golden ticket, and why others could be a ticking time bomb. You'll also learn the reason you'll be celebrating every single April 18th as a passive real estate investor. Then we'll wrap it up with 2 unsexy phrases that are crucial to your real estate success. So without further ado, let's dive in. If you're watching this video, you're probably at least vaguely familiar with the concept of passive real estate investing. By the end, you're going to be a pro. Passive real estate investing offers a lot of unique benefits that don't necessarily go along with other forms of investing. Some of the benefits that you may not have considered include steady cash flow. Active real estate investments, like flipping or wholesaling houses, for example, they often require a ton of ongoing work and expenses. Trust me, I know, I've invested in single family for years, and sometimes the headaches can be non-stop. Investing in real estate passively can provide that same consistent income stream, or better frankly, with minimal effort on your part, because the sponsor of the deal handles the management aspects. All you have to worry about is collecting your cash flow and returns in the short term, and then building legacy wealth and financial stability over the long run. You get diversification. This is that safeguard that I mentioned at the beginning of the video. Passive investing offers the opportunity for instant diversification, which means a more stable portfolio. When you invest passively, you open yourself up to the possibility of investing in deals and asset classes that you may not have had the time or the experience to invest in by yourself. For example, with something like a REIT or a real estate fund, you're often investing in a portfolio of expertly selected assets from day one. By investing in a variety of asset types, you can reduce your overall risk and create a more stable portfolio. Again, an active investor, he's out there flipping a house or renting a single-family home, and that's all he or she has, that one single asset. Single-family homes can be great, but you're completely beholden to that one very particular risk in that one single property and all the different aspects associated with that one property poses. Tax benefits. Passive real estate investments often come with major tax advantages, such as depreciation and deductions for expenses. These tax breaks, they can help offset your taxable income, potentially saving you a ton of money over the long run. By investing passively, you can generate income without the headaches that come with actively managing properties, ultimately giving you more time to enjoy the fruits of your investment, which is what real estate investing is all about. And we're trying to generate real freedom through passive real estate investing. There are several different types of passive investments that a first-time investor should keep their eye on, each with its own unique set of advantages and risks. Some of the most common passive investment options include real estate investment trusts, otherwise known as a REIT. This is a popular one right now. REITs are publicly traded companies that own, manage, and finance income-producing properties. That's not to be confused with private real estate funds, but more on that in just a minute. By investing in a REIT, you get a share of the income that's generated by the properties without the hassle of managing them yourself. REITs, they also provide diversification, as they typically invest in various different types of properties and various different geographic locations throughout the country. REITs can be a great option for you, but this investment usually comes with pretty hefty fee structures, and they can be correlated to the broader stock market, which is one of the downsides associated with REITs. Another option is private lending and mortgage notes. By lending money to property owners or investing in mortgage notes, you can earn interest income without managing the properties. This can be an attractive option for investors looking for a more hands-off approach to real estate investing. What about real estate syndications and funds? As opposed to REITs, these type of investments pool together investors' money to actually buy properties, which are then managed by an investment firm or a trusted third-party management company. In this scenario, the investor owns actual shares of the properties inside of the fund without the hassles of the management. They literally take title to the real estate itself. Syndications and funds offer the potential for higher risk-adjusted returns and more diversification than investing in a single property or a REIT, from my perspective. They also allow you the opportunity to invest in larger deals that may be out of reach for individual investors, which often means higher risk-adjusted returns and potentially higher upside for the investor. Let's dive deep into some of the specific benefits of each one of these. Some of the benefits of investing in REITs include liquidity. Since REITs are traded on the major stock exchanges, they can easily be bought and sold, providing you with much more flexibility to adjust your investment strategy as needed. They also provide diversification. REITs invest in a variety of property types and locations, which helps spread risk across your investment portfolio. They have professional management. REITs are managed by experienced professionals, and that ensures that the properties are well maintained and efficiently operated, which can lead to higher returns. They provide dividend income. REITs are legally required to distribute at least 90% of their taxable income to shareholders in the form of dividends, providing investors with consistent income stream over time. What about real estate syndications and funds? Real estate syndications and funds, they pool together investors' money to buy and manage properties. These investments offer the potential for higher returns and more diversification than investing in a single property or a REIT, in my humble opinion. Some key aspects of real estate syndications and private real estate funds include access to larger deals. By pooling resources, investors can participate in larger, more lucrative deals that may be out of reach for individual investors. They provide expertise and experience. Syndications and private real estate funds are managed by seasoned professionals who have extensive knowledge of the real estate market and can identify and execute profitable investment strategies. You also have shared risk in these types of investments. By investing in a syndication or a fund, you share the risks and rewards with other investors, potentially reducing your overall risk exposure. You don't have all your eggs in one basket. You have passive income potential. As a passive investor in a syndication or a fund, you can receive income from property rents and profits without being involved in the day-to-day management of the properties. To keep maximizing your potential for cash flow and financial legacy, make sure you hit the subscribe button, like this video, give us a thumbs up, and leave a comment with your thoughts or questions. We look at every single one of those, guys. How about private lending and mortgage notes? Private lending and mortgage notes, they're another option for passive real estate investing. Here are some key points to consider. Interest income. By lending money to property owners or investing in mortgage notes, you can earn interest income, which provides you with a steady stream of passive income. You have security. Your capital has security in the capital stack. Mortgage notes are secured by the underlying real estate, which means that if the borrower defaults, you have the right to foreclose on the property to ultimately recover your investment. You have more control. As a private lender or a note investor, you can set the terms of the loan or your note, allowing you to tailor the investment to your specific needs and risk tolerance. This is often something that we see in seller financing, where folks negotiate very specific terms, basically the duration of the amortization or the certain amount of interest to ultimately create the type of income you need for your lifestyle at this juncture of your life. You also get diversification. By investing in different types of loans and notes, you can further diversify your investment portfolio and reduce your overall risk. Hey guys, well, this video is getting a little bit long. It's been part 1, so please join me in part 2. Guys, we got a free gift for you in the description of this video. Look, we're here to help you as much as we possibly can in every step of your investment journey. But it's no secret that our favorite asset classes are mobile home parks and parking facilities. It's what we do every single day. It's what we know. It's what we like, what we trust, what we love doing. And we know it like the back of our hands. If you want to learn more about what, in my humble opinion, is the best asset class in all of real estate, click the link in the description to get our free guide. It's the Passive Investor's Guide to Mobile Home Park Investing. Thanks for joining us today in our quest to help you become a successful passive real estate investor. Remember, by carefully choosing the right investment opportunities and understanding the benefits of passive investing, you can create a steady income stream and secure your financial future, providing real freedom through passive investing. Don't forget to hit the subscribe button and like this video, give us a thumbs up, and leave us a comment with your thoughts or your feelings in the comment section, guys. If you got questions, please let us know. We'll see you in the next video.